We are very excited to jump into our webinar, Carbon Accounting 101 today. We'll just wait for a few other people to join. Get your questions ready. Really want this to be an interactive session, as it always is. But we will just wait about 2-3 more minutes, and then we'll kick everything off.
Fantastic. Yeah, exactly. I'm here manning the chat. So if there are any questions, please send them in, and I'll make sure to both respond and also alert Alex of the questions as they come through. So please don't be shy. We're here to help you with your specific needs, questions, and interests around carbon accounting and sustainability. So please do ask as many questions as you can. And as another starting point, what we usually do here in our webinars, just as a first engagement, is if you can just put in the chat what industry you're from. You don't have to worry about putting your company, but what industry you're from. And if there's any one thing that you're interested to learn about today, just so we can make sure to tailor some of the content towards the industries in the room and the key learning areas that you guys are after.
Yeah, great. Thanks, Lockie. Yeah, as mentioned, for the other people just joining now, we will kick off in a minute or two. Just let everyone kind of get through that registration process, those questions when you do join. And then we are going to be going through and breaking down every aspect of carbon accounting. So really want everyone who's already in here to understand that there are no stupid questions today. There are no basic questions. This is about dismantling carbon accounting to its most basic elements, and really really looking to improve that knowledge. So often now carbon accounting is just, and if we're expected to understand how it works, or carbon offsets and carbon neutrality are just thrown around as if they're concepts that everyone has a really innate understanding of. So we're gonna dive a little bit deeper into that today. Some people saying this from software industry. So obviously speaking to a lot of people in the software, a lot of people in professional services, a lot of the clients who are really interested, or this industries and companies that are really interested in carbon accounting at the moment are the ones who are serving those larger corporates. Because as we're going to touch on right now, those larger corporates or larger businesses have a lot of pressure on the mandatory reporting requirements. So wait 1 more minute or so, and then we'll jump into it. Yeah, great. Another kind of question that touches on what's called emissions boundaries, which we'll be covering off around hospitality. All right, great. Well, I can see enough people in here, so we're just going to kick it off. Can see a few familiar names, familiar faces, but by way of introduction, my name's Alex King. I'm head of customer success here at NetNata, and what that means is that my primary responsibility at NetNata is to helping people to achieve their sustainability goals. And with everything that we do and everyone we work with, the main vehicle for achieving your goals is through carbon accounting, how we're calculating your carbon emissions, and then using that calculation to then serve many different types of purposes. So today, this is Carbon Accounting 101. We are going to be going through a presentation that really explains the why, how, and the results, understanding the methodology, and then also delving a little bit deeper into the most logical, the most common next steps for once you have done your carbon account, things like carbon neutrality, carbon offsets, and mandatory reporting requirements. So as mentioned earlier, if you do have any questions at any time, just chuck them in the chat. Lockie our founder, will be manning it and making sure that we don't miss out on any questions. And again, there is no question too simple or too basic today. Really want to kind of strip it all back. So a little introduction to NetNada, who we are, what we do. NetNada is an Australian sustainability and technology business. It's assisted hundreds of companies, not just here in Australia, but all over the world. Got a really good presence now in the US and the UK, and we will be touching on some of their reporting requirements and also their influences. And we work with everything from one-person companies to listed companies, both on the ASX and elsewhere. So, but what we do for everyone at its most basic is carbon accounting, the calculation of carbon emissions. So today, we're very well versed to talk about this. Always keen to kind of hear your insights and inputs. So if you do have anything you'd like to add at any point to what I'm speaking about, please jump in. Very, very collaborative, our approach here. So any experience or insight from your own carbon accounting journey, please let us know. So we're going to zoom right out to begin, and we're going to, look at climate change, this broader journey. Why are we even here on a Wednesday at 12:30 talking about carbon emissions? Why is it relevant? Why is it important? Why should you even care? And, what carbon accounting allows us to do is participate in this overall journey that we have been on for, close to 30 years now around climate change, carbon emissions, and reducing the overall warming of the earth. So what we're needing to be doing, you see this graph on the right-hand side is, and we'll touch on how this goal came about in a second, but it is to reduce global warming to 1.5 degrees in comparison to pre-industrial levels. Now, the science behind doing that is that we will avoid a lot of the catastrophes, the crises across the world by achieving that target. So, but in order to, reduce and head there is the need to calculate. And now with this acceptance across governments and nations across the world, it's becoming more and more of a license to operate rather than just a nice to have to be a sustainable business. There's more regulatory pressure, there's increased stakeholder expectations. This is a risk for companies now. Increased costs and efficiency lost. And, at the moment, though, there is still a competitive advantage for moving fast in this space and adopting it. And we find it really helpful to kind of frame all of this journey and, the reason why there is so much pressure into what's come about. So in 1997, as many people may be aware of or heard the frame or the term, the Kyoto Protocol came about. So that was the creation of the greenhouse gas protocols. We need to standardize the way we calculate carbon emissions. We know they're bad. We know that they're harming the earth, and we know that they're leading to negative effects on climate change. But back then it was still, what is the impact going to be? But we do know that we do need to standardize and create so we can compare, reduce, and report. Not much happened, in way of huge historical moments in the space until 2015, when we had the Paris Accords, another meeting of the UN. Kyoto Protocol was a meeting of the UN in which nearly all first world countries around the world made a commitment to reducing to that 1.5 degree or targeting that 1.5 degree of science-based target. Now, that was a commitment of the States, but when things really started to ramp up and started to get interesting is in the past 2 to 3 years. And just in 2023 and 2024, we've seen this move from a commitment from governments to actually being a requirement, a mandatory reporting of the private sector. March 2024, where the SEC over in America announced that they will have this as a mandatory reporting requirement for their companies. More details to come out from them, we expect, certainly after the upcoming election. UK government, EU has been far ahead for many years, but Australia has as well brought into law, our mandatory reporting requirements, which will kick off from January 1st, 2025. So it's gone from, we know it's bad, not sure what to do, to, okay, let's make a commitment, to now it is becoming law. And this is why it's more and more of a ripple effect across all industries and expectations. Again, just another touch points on some greater sustainability landscape, both here and overseas. We have those really large, top level mandatory reporting requirements. But then what we're seeing is, rather than just having this, we could call it the stick incentive. If you don't report properly, you're going to be fined or, enforced, just like taxes are. There is the carrot, the use of procurement, especially by governments, to encourage people to adopt sustainability. So the UK has had it since 2021, with which any tenders or grants over a certain level from the UK government require you to report and calculate your carbon emissions. And this has been announced that it will be coming in to the same effect in Australia in the coming year. And we will see this, like, more of an incentive to report or to have your carbon emissions calculated will lead to better outcomes, especially with working with government. And because of this mandatory reporting requirement of larger businesses, we will see this with working with larger corporates. There's a lot of industry-specific legislation, especially around agriculture, healthcare, construction, infrastructure, and defence. We could speak to this for a long, long time. And if you are concerned or you've heard about any specific industry legislation, how it's going to impact you, please just shoot us a message or ask the question in the chat, or shoot us a message separately. And we can jump in and speak about that separately. Finally, before we kind of come back down to the most basic aspects of carbon accounting, is this Australian kind of criteria for mandatory reporting requirements. You can see here, to focus firstly in the purple, is that you must meet 2 of the 3 reporting requirements. So it's 500 million or more. 500 employees is a pretty common one. This is all the people who are going to have to report on 1st of January 2025. It's quite a lot of companies. Over 6,000 companies will fall into these mandatory reporting requirements at the current stage. What we're going to touch on in a second is, what does this mean for everyone else? We do actually have a separate webinar coming up next week, which is completely dedicated to, well, I don't fall within, the 500 million, what does it mean for me? And it actually means quite a bit, because, as we're going to explain in a second, within the scope 3 emissions of these businesses sits anyone who's doing work with them, anyone who's one of their suppliers. So yeah, we've got plenty of resources, more information about this, but it's obviously, the hot topic at the moment is a reason why there's so much interest in the carbon accounting space, both here and overseas. So I promised we'd strip it back, and we're going to take it right back. So this is some of the basic elements of carbon accounting. And one thing straight off the bat that you can take away from this webinar, and if you are new to carbon accounting sustainability, is the conflation of carbon neutrality and net zero. We see it all the time. Some people will go out and they'll buy a couple of offsets and they'll say, we're net zero. Which, in fact, the two terms are very, very different. Carbon neutral refers to the process of calculating carbon emissions and then offsetting them with an equal amount of carbon offsets or carbon credits, as we'll explain in a second. And then you're reaching a level of neutrality. What you emit is offset by purchases, or you reduce, there are different criteria, but generally 90% of your carbon emissions. In some industries, and it could be argued at the moment that net zero is not technically possible right now. It will be when we can reduce, and when your scope 3 can be reduced considerably, but at the moment it's very, very, very difficult. That's why you hear all the time businesses being carbon neutral, but their net zero target will be 2035. 20 is a pretty ambitious target, in 2050 even. Carbon accounting is the actual just term of calculating a business's carbon emissions. And one thing we'll touch on in a second here is, and I say this all the time, I do feel that often that carbon accounting, the term, can be a little bit misleading, because accounting itself is very black and white. Everything balances out. There's one way to do it. There's one correct way to do it. Whereas carbon accounting is a bit more of an iterative process, as we'll explain in a second. Obviously calculating and quantifying and getting perfectly the emissions of one business within such a broad business landscape is pretty difficult. We've come a long way. More and more and more, we're getting more and more accurate. The next here is CO2e. So always seen as carbon emissions. I'm sure you will have heard of, methane or nitrous oxide, which are also greenhouse gases. So to make it simpler for everyone, how it's done is that everything is boiled down to a carbon dioxide equivalent. Like methane, for example, 1 part methane is around 32 parts carbon. So everything is brought into CO2e, and that's why carbon emissions is the most commonly referred to greenhouse gas. The GHG protocol corporate standard. Anyone who's worked with NetNata has seen our communications that we always kind of talk to aligning with the GHG protocols. And the GHG protocols, if you remember, what came out of the 1997 Kyoto protocols. This is the Bible essentially of how to calculate carbon emissions, and very, very, very rarely, in fact, it's probably a red flag if you hear this, but all the carbon accounting solutions, the consultants, ourselves, we haven't created a new way of calculating carbon emissions. What we're doing is making it much more efficient, much quicker, and much more affordable to calculate your carbon emissions based on the methodology or the outlines within things like the GHG protocols, the corporate standard, because this is what large corporates and companies and governments are reporting to. And what they broke down emissions into are 3 categories: scope 1, scope 2, and scope 3, which we're going to touch on in a second. And it can be a little bit difficult sometimes to wrap your head around it. But if you can imagine in the late 90s when they were making these divisions, these were the things that could be quantified and calculated rather than your scope 3. But your scope 1 is your direct emissions from your own controlled sources, your company vehicles, predominantly the fuel consumed in your company vehicles. Also, some emissions coming from your company facilities, mainly refrigerants. Now, the main thing that you'd have to think of, and it's quite often for many like professional services or software or NetNata, for example, we don't have any scope 1 emissions when we calculate our own emissions because we don't have company vehicles. We're not consuming fuel, and we don't have refrigerants of note within our office setup. Scope 2 is all of the purchased electricity, heating and cooling by the business. Anytime you're consuming gas or consuming electricity directly, that is your scope 2. And your scope 2 at the moment is probably the easiest to reduce. And a lot of the times you'll hear kind of solutions or reduction strategies focused around scope 2, because scope 1, if you want to reduce the fuel consumed by your business, you need to either make a pretty large capital investment and move into an EV, electric vehicle, or you need to be looking at a hybrid or more energy efficient car. Scope 2, though, however, the consumption of your electricity, that's something that can be changed quite easily. You can change energy providers. You can now purchase green energy from the grid. Solar panels, for example, are a great return on investment at the moment. So scope 2 is quite easy to consider. It's just the purchase electricity. Scope 3 is everything else. And this is a very famous diagram from the greenhouse gas protocols. I would say, the categorization can be a little bit misleading. Most of the time, 80, 90% of your emissions are probably going to sit within the purchased goods and services. But this is how they've broken it down. And if you've got any questions on this or how it works, we can delve into it a bit deeper. But if you just think about that, scope 1 is your fuel consumed by the business, often sometimes refrigerant. Scope 2 is your electricity. Scope 3 is everything else.
There's just one question in the chat, Alex.
And yeah.
Sorry. There's just one question in the chat in regards to the scope 3 asking, how do I measure and then also reduce my scope 3 emissions? Is that one you want to answer now, Alex? Or
certainly. And it's a great question. I think we're gonna touch on that very, very soon. And it's great and anticipated greatly. And the answer is that, I guess touching it quickly, is that it was quite difficult previously, and this is why scope 1 and scope 2 is the only thing mandated right now from SEC has come out and said they're just going to do scope 1 and scope 2. Australian government for the first reporting is just scope 1 and scope 2. back for a long time, it's just scope 1 and scope 2 reported. And this is why, scope 3. And it is difficult to calculate, or it has been now. This is why companies like NetNata exist. And we'll touch on it in a second. But yeah, this is kind of, again, touching on the emissions in your value chain, supply chain emissions, scope 3 emissions are all kind of interchangeable terms. We've kind of touched on this. Upstream and downstream is often another kind of delineation between the use of products or production of business. However, I think it becomes a lot easier to understand when we kind of break down the ways that we calculate this. So the majority, the lion's share of scope 3, if we're looking at the whole scope 3 of the business, not just certain areas, the easiest way it's done is by spend-based analysis. Now, this is when we look at all the transactions of a business, and each transaction is allocated a specific emission factor. And we're going to break this down a bit simpler in a second. And this kind of ties into what is called, the environmentally extended input-output method, with which we're taking, certain inputs, putting them into an emission factor, which is being created by generally, large academic bodies. And then it's giving us this output, which is the expected emission factors. We have an example in a second. Now, spend-based approach is obviously using an input of dollar spend against the emission factor. But this is how scope 3 is largely calculated. And with the spend-based approach, we're looking at every supplier, every contractor, every transaction of the business. And I guess I find it easy just to kind of take you through an example from the platform to show how, at this granular level, the scope 3 is calculated. So this is an example of spend-based analysis for a client, and it's looking at, there's one supplier, but there's 28 transactions from the supplier. You need to look at it from a transaction level, because otherwise, as like an example, like Amazon, you could be buying lots of different products or lots of different services from Amazon. So we look at it at the transaction level, not just the supplier level. But you can see here that the input activity is $1,000. And the input is being put against an emission factor of computer and technical services under professional services. Now, this emission factor is from IE Lab, which is Australian-based. It's from memory around 8 different academic institutions, University of Sydney, University of New South Wales, all come together with huge data points to calculate using, so many different aspects, the expected emissions associated with an activity. So for this example, it's computer technical services. $1,100 spent is applied against the emission factor, and that gives us 0.16 CO2e, or tons of carbon emissions. Now, if you think about all the activity of a business is applied against this model, every single piece of expenditure is put against an emission factor, which then gives us the transaction emissions. And whilst we've kind of mentioned, this EEIO model, it doesn't just work for spend, it also works for activity-based. And as you can imagine, with your electricity bill, for example, we don't want to see how much it costs, because cost is not a good indication when we have better insight into activity-based data. What we would use is your kilowatts per hour against an emission factor. And kilowatts per hour, same sort of thing with tons of waste. Tons of general waste is a much better indicator than how much money you spent on your general waste. And flights, the same thing, kilometers traveled against an emission factor. And this is
I think as well, Alex, to that point, it's like a great way to explain and respond to the question that was asked in the chat about measuring your scope 3 emissions and reducing it. And I'm sure, as everyone now can see, when you first analyze your scope 3 emissions, if you are just using the spend-based method, you're just simply taking the amount of money spent, so say $1,000, you're timesing that by the emissions factor that's given to your supplier based off their primary industry category and their subcategory. So say, food and catering services in Sydney, New South Wales, they get that emissions factor. Now, that's how the initial measurement occurs. And to the question in the chat, well, how do I reduce this? Obviously, we're not asking, or no one in carbon accounting is asking you to just start spending less, because that is not always something that a business that's growing, or any business for that matter, can do. But what you can do, and what Alex has highlighted here, is you can then get more granular data from the suppliers. You can work to get activity data, which is that specific units of measurement that is relevant to those scope 3 emissions that have been given. And then you can start to see that, okay, this is either lower because it's more accurate than the benchmarked assumption-based spend figures that were given, or maybe it's higher, but still more accurate. Okay, now it's time to think about my sustainable procurement policy. Now it's time to pull levers on what I consume, who I purchase it off, and how sustainable my suppliers are. So in answer to that question in the chat, hopefully that helps it.
Yeah, that's such a good point, Lockie. And it just goes to show as well that you could start with just a spend-based approach of all your data, but we're constantly looking to improve, get more granular data, because once you have a really close, accurate picture, that's when it's easier to reduce. If we don't know, for example, exactly where the emissions are coming from waste, because all we can see is that we spent, I don't know, $10,000 with JJ's waste and recycling. But if we know, okay, actually, if we enrich this data and got activity based, we know that we're actually putting 10 tons into our general waste, and we're putting 1 ton into our recycling and commingled waste. Okay, to reduce our scope 3, we now have the insights to recommend that we need to improve our waste diversion. We need to move more waste from general into recycling. It's very low at the moment, and that would lead to reduction. But until you get the more granular data, you don't have those insights to guide your decisions or help you reduce your scope 3.
Yeah, 100%. And I would say as well, and we'll go through this, but if you're listening to this webinar right now and you're thinking, I'm struggling to understand how these units of measurement connect to my business, I'm struggling to quantify what all of these numbers really mean. What does tend to be very helpful is when you eventually get to doing your own analysis of your own business, or maybe you already have, it helps you understand in context, oh, okay, this is, how many emissions my energy consumption produces. This is how much emissions our, fuel consumption produces. This is how much emissions the, food catering services that we consume every month produce. And your business better than anyone. So what those purchasing and activity habits look like. And then once you start to get the numbers back on what that means from a CO2 equivalency, it's very, helpful to contextualize it into your own business activity.
Yeah, that's exactly right. And it goes to show with this graph as well, is that this data collection and calculation is really at the core of achieving so many aspects of sustainability. We have our spend-based and activity-based data. We're pulling that in together with conversion factors. We also may be going and speaking, as Lockie kind of touched on, to individual suppliers, seeing what they can give us. Once we have all of that data, we're then inputting it into emission factors. What that is then giving us is our calculation, our results. Now, carbon accounting is generally always done on a year basis, financial year or calendar year, doesn't matter, but because reducing, improving, collecting is something that's not just done each week or each month, it's compared year on year. But once you have that year piece of analysis, then we can start to looking at, what's our target setting? What are our reduction initiatives? How are we engaging our suppliers, or putting together a procurement strategy, or complying with regulatory investment requirements? Then all of the sustainable branding and other actions. There's so many more to kind of sit in this far right column, but I guess it kind of just shows you how it all leads to what is good sustainability in 2024 and beyond. Yeah, again, to reinforce that point, it's continuous improvement. A good example is we work very closely with Zip. Zip, as you can imagine, doesn't have any scope 1 emissions. They've got very little scope 2 emissions, because over the past 6 years, they've been a real kind of environmental leader. They've reduced as much as they can. So they've only really got their scope 3, and it's still quite considerable when they've got hundreds of employees across the world. So they understand that right now they don't have that much capacity to reduce just based on where capability is at the moment. So what they celebrate and what's really important to them is this in continuous improvement. It's about getting more granular data. It's about improving how, they put together all their activity data, all the supply and specific data, because that is such an important part of carbon accounting. And we see it all the time. From the first carbon account you do to the second or third is wildly different. May not be wildly different in the end result, but it's very different from what you include and how you do it, because we also understand that a lot of these businesses we speak to, this is a part-time small aspect of your internal resources. So we always help to kind of suggest the most suitable path to getting an accurate analysis, and then on the next year it gets easier so we can include more things. So you always want to reduce where possible, and also always want to be improving your kind of data systems, how you're capturing. 1 year you might not have your waste data, or 1 year you might not be able to pull all your flights, and the next year we do that, or the next reporting period we do that. It's kind of a nice segue into what is often the most asked about, or kind of like logical association with carbon accounting, and it's carbon offsetting and carbon neutrality. And this as well ties into nicely the sense of these larger corporates, how they're looking across their supply chain and kind of seeing it as a potential risk, or seeing it as not just something that sits on the ESG side, but also potentially sits on the financial consideration side, because carbon liabilities is another term that gets thrown around, and the total amount of carbon of a business can be sitting as a bit of a threat on the balance sheet. And this is because if a company has made a commitment to offset or to be carbon neutral, every year that they calculate their carbon emissions, they need to purchase carbon credits to offset that amount. So they're looking across their scope 3 emissions, go, how can we reduce? Because just by reducing, we're also reducing our bill for carbon neutrality. But to take it back even further, what is carbon offsetting? And it is leveraging projects, initiatives such as deforestation projects, wind farm, reforestation projects, mind you, wind farms, to reduce, remove, or avoid greenhouse gas emissions. Now, carbon credits are, one carbon credit is 1 ton of CO2. So when you see the purchase carbon credits, generally it's in relation to how many tons of carbon emissions they had for a reporting period. There's lots of different projects and registries. ACCUs are the Australian government approved program, and a lot of the time, well, less and less, you don't see kind of any stipulation of where people need to purchase carbon credits from, but it regardless of where you're purchasing them from, it all follows the same process of offsetting. So you obtain a carbon credit, you then retire the carbon credit. Now, this is important because the retirement can only be done once against one organization for one reporting period. And then that's 1 ton offset. Carbon credits are, more often than not, financial instruments. They're traded, bought and sold at highs and lows, just like any kind of stock or derivative. And therefore, this is actually quite an important piece of the puzzle to understand, is that they can be obtained, bought and sold many times, but they can only be retired once. Again, just to kind of few kind of fundamentals of it, projects create credits. Some projects will create hundreds of thousands of credits over their lifetime, but one carbon project, you will buy carbon credits. Even the person who's, just watched the news a couple of times understands that there is a lot of skepticism and concern often around carbon offsetting. Aren't they all dodgy? And a lot of that kind of initial kind of landmark case was both this one about the REDDs, which said someone came out and said 90% of carbon offsetting credits are generally phantom credits. And then it was another study, another kind of investigation into ACCUs, when there was a lot of issues around additionality, where projects were being licensed were already going to happen. They were saying that they were going to reforest. They were already going to happen, or were going to have no impact. A lot of tree planting programs were happening in the middle of Australia, where trees were never going to grow. So, things like that. But the criteria and the regulation around carbon credits has really shored up in the past year, past 2 years, is continuing to be, because there's a lot of pressure from both governments and large companies, because there's a big reputational risk if you're purchasing a lot of carbon credits and then saying you're carbon neutral when really they're not genuine and they're not having any impact onto the environment. Some people as well, some organizations are kind of ditching carbon credits, and instead using the money they would have invested into carbon credits into investing into more sustainable practices or procedures in their business, such as Telstra this year. But it is still a very powerful tool, and it's a powerful tool for a number of reasons. First one is that often people who have the most rudimentary understanding of sustainability will recognize carbon neutrality, and they see that as what it means to be sustainable, to be good. So you can still leverage that. And secondly, is that when you are carbon neutral, and if a business analyzes you in their scope 3 supply chain, they're able to reduce or eliminate completely the associated emissions. So it can be very strong. NetNata offers carbon neutrality. We don't sell carbon credits. We don't own a commission on carbon credits, but if it is something you're interested in, we can help you and take you through that a bit more. As it is something we do quite commonly. But I guess the point of it all is that it is not the be all end all of sustainability. Is a good way to think about it.
I think as well, just adding to Alex's point there, wherever you end up getting carbon credits, if you do go down that route, and it could be this year, next year, 5 years' time, I think the main thing I would remember is look at what the incentives and motivators are of the entity that you're buying those credits off. Make sure that you're very, very clear with them that you want to understand what commissions or clips they may be taking. Because what tends to happen is it's very ambiguous and unclear about where their incentives lie and how much financial commissions or clips they are putting on. And so you want to make sure that, of course, for your own pocket's sake, but also for the clear definitions around what are potential conflicts of interest and any biases that may occur because people have misaligned financial incentives. So I would flag that as something for everyone in the room, just to make sure they check when they do offset anything at any point in their careers.
Yeah, and we're happy to kind of review them as well. We usually have a stable of projects that we've had a look at, 8 to 10 at a time. So if you are kind of at that stage and just want someone to have a look, we're happy to do that. No problem at all. Carbon certifications. So there's a number of carbon certifications. The most famous or well-known one in Australia, the only one offered by the government, is Climate Active. Climate Active is a strong brand. Obviously, you're associated with the government. There is a lot of considerations and hoops to jump through, as with anything with the government. But it is, it does show that there's been a lot of change in this. I guess I could have a whole session actually just speaking about Climate Active, and we won't go into it too much. But we are seeing carbon neutrality, carbon neutrality not being the only requirement to achieve a certificate. B Corp, for example, B Corp now requires you to analyze your carbon emissions as part of their new certification, but you do not need to be carbon neutral. With Climate Active, you have to be carbon neutral. What you'd be doing. Same with CDP. CDP's international project, Climate Disclosure Project, and over 2/3 of the world's market cap participates in this project. Very, very big. Also looks beyond just your carbon emissions, but again, does not require you to be carbon neutral. So there are a lot of options on that larger scale. And again, all these certifications are really strong, but they do require more work, certification, licensing fees. So it's always important to kind of consider about what your end goal is with one of these certifications. That's it for the moment. I know we kind of race through like so many concepts, but it's always good to kind of leave the end part to go through and see if anyone has any questions or to discuss any individual I guess scenarios as well. We're more than happy to kind of break it down.
So there's one question here in the chat, Alex, that says, my biggest client has requested that I provide them with my sustainability information. Does this only include my carbon data, or is this broader reporting?
Yeah, it's a very topical question. It goes beyond, at the moment, larger corporates across all levels are really kind of figuring out what the criteria is for how they understand and analyze their supply chain. 100% they're going to be interested in your scope 1, 2, and 3 emissions, especially if they've been done in line with GHG protocols. It's what allows them to move you beyond just a spend-based analysis into supply-specific data. However, they're also going to want to see anything else you have within this realm. I would be, when you have these requests, looking at it as an opportunity to showcase any other ESG credentials you have, such as modern slavery, or again, climate-related risk or scenario analysis you may have done. Yeah, it's not just confined to scope 1, 2, and 3, but I do think that is at the moment the most important consideration on their behalf.
I would also just add to that point that you may feel as a SME or as any organization who's a bit newer to this, that there's a lot of jargon and confusing points, and hopefully today Alex has helped answer a lot of those concerns or areas of uncertainty you had. But just know that some of the big companies as well are in the same boat, right? You've got sustainability, professionals, teams, or maybe sometimes people in big companies who have just been thrown this responsibility, who are equally, a bit nervous about their requirements to report. So my suggestion would be, as they're figuring things out, you're going to get different requests and reports from 10 of your biggest clients. And so just if you have any questions about what requests you're getting, feel free to send them over to Alex or myself, and we can help point you in the right direction if it is just carbon reporting or if it's broader. We can let you know. Chances are we've probably seen these requests as well before.
Yeah, exactly right. Exactly right. And any other questions beyond this, please just shoot them over and we'll be able to help you with that.
Fantastic. Well, I think that's it. Is there any other questions? You are anonymous in the chat, so if you want to shoot questions in, go for it. No?
No, okay, great. Well, we'll send over this recording as well. And so feel free to share that. And we are running a number of different sessions at the moment. The mandatory reporting requirements. One is next week, and then beyond that, just keep an eye on your emails. We'll send through a few other invitations.
Fantastic.
Great.
Okay.
All right. Have a lovely day, everyone. Thank you.
Thanks, everyone, for coming. Bye.